Here's something almost everyone gets wrong about the stock market. People assume a company sets its own stock price, or that the stock exchange sets it, like a store sticking a price tag on a shelf. Neither one does. So who actually decides what a share is worth? The answer is stranger and simpler than it sounds. A stock's price is nothing more than the price of the last trade. When you see a stock at some number, that number is just what one buyer and one seller most recently agreed on. Nobody printed it. Nobody approved it. It's a receipt from the most recent handshake, and the next handshake can land on a different number a second later. The market is really a giant, nonstop auction. At any moment, buyers are naming the highest price they'll pay, and sellers are naming the lowest price they'll accept. Picture a stock trading at $10. More buyers show up than sellers, so one buyer offers $11 to jump the line. That convinces a few holders to let go of their shares. And now the last trade, the price, is $11. Demand just moved it, and the company didn't do a thing. Flip it around. When sellers are rushing for the exit and buyers hang back, sellers cut their asking price to find a taker, and the price falls. That tug of war, demand against supply, is the entire engine. Which raises the real question. If buyers and sellers set the price, what makes them suddenly want to buy or sell? This is where most explanations stop at good news up, bad news down. And it's exactly where they go wrong. Markets don't trade on news. They trade on news versus expectations. Here's the part that trips people up. A company can report record profits and watch its stock fall. How? Because investors already expected those record profits and had already bought the stock in anticipation. When the result merely matches what everyone assumed, there's no new reason to pile in. And the people who bought early sell to lock in the gain. The number that moves a stock isn't the result. It's the surprise, the gap between what actually happened and what the market had already priced in. That surprise can come from anywhere. An earnings report that beats or misses what analysts penciled in. A Fed decision that lands harder or softer than traders bet on. Inflation, jobs, or interest rates coming in hotter or cooler than the consensus guess. Even a shift in mood, confidence in a whole industry rising or fading, can move every stock in it, regardless of how any single company is doing. The mechanism never changes. New information gets measured against what was already expected, and buyers and sellers reprice the next handshake. Stretch the time frame out, though, and the noise quiets down. Minute to minute, prices jump on sentiment and surprise. But over years, a stock tends to track the real value the business builds, its earnings, its growth, its staying power. Short term, the market runs on expectation. Long term, it runs on results. So, back to where we started. The company doesn't set the price. The exchange doesn't set the price. You, and every other buyer and seller, set it together, one trade at a time, by constantly betting on whether reality will beat what's already been assumed. The price tag isn't handed down. It's negotiated every second the market is open. We cover the markets on the days that actually matter, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.